afternoon. You're watching the newsroom right here on ET Now. I'm Ajaya Sharma. The markets have rebound very nicely on an intraday basis. We are looking at almost the highest point of the session right now. Nifty, Bank Nifty, both have gained very smartly in trade. Let's talk more about markets and the factors which are at play right now. Lakshmi Iyer is joining us from Kotak. She's, of course, the CEO of Kotak Investment Advisors. Lakshmi, afternoon. Thank you so much for your time. There were twin good news on the inflation front. CPI, India CPI, US CPI, both came in on the lower side on expected lines. Is it reason enough to cheer that, there is a big pause which lies ahead for US and ours as well? Or this is not a confirmation which markets are so happy about right now?
Ajay, clearly, this is definitely one of the positive news because inflation has been the sore point for most economies across the world. Of course, largely for developed economies, but clearly the confluence of factors across only an important part. That on the lower side, that's certainly good news. Why it is additional good news, I would say, is because the trend line from, if you look at extrapolating this into, say, FY 2024, the chances are that it may undershoot RBI's own projections. That remains to be fairly high. And if that happens, which is what the expectation is, then is there a case to probably expedite rate cuts, which of course is another at least 2 quarters away? I think some of these narratives are what will do rounds in the market.
Lakshmi, we also saw this morning, in fact, overnight, the short-term rates in China, and this morning's commentary seemed to be suggesting that further policy easing and perhaps some kind of a stimulus also is being planned. At a time, global growth completely remains an issue. Can this kind of accelerate China change in stance towards easing? Could US follow? Because nobody wants a crash landing of global economy and hence may step ahead where growth takes a precedence, inflation seemingly getting topped out. Do you think that case building going into the second half of the year?
So right now, Ajay, if you see, China is being plagued with a very weird or a very strange issue, which is obviously that even after the opening up, the consumption demand is not really picking up. The economic sluggishness still continues to remain. So what will the policymakers do to pump prime the economy? One of them is this the cash reserve cut, trying to get in more steroids into the system so that the economy gets back on the path of recovery. I think that is what, is being envisaged. And also, obviously, because of whatever issues we've seen in the past, especially with respect to geopolitical, etc., China was obviously a very different case in point. If you look at the US, it's actually a tale of two cities. If you look at the employment data, it's absolutely rock solid, which doesn't really create any strong case for even a pause. But if you look at the housing data, that's clearly telling you, and the kind of price point corrections that we are seeing is clearly telling you that more than a pause, it's time ripe to actually try to ease interest rates. So I think the Fed will have to adopt some sort of a mid path, similar to what Canada did, then take stock of the inflation. And if things continue, at least for the next 2 quarters, then probably top it up with rate cuts. So, and last but not the least, if I see India, we are looking at an extended pause, and intuitively, the next action in India should be actually a cut. The timing, of course, to a large extent, will depend on how US pans out over the next 2 quarters.
Lakshmi, how have you been talking to your team in terms of valuations, earnings quality, all of that, after taking stock of the quarter gone by? How are the valuations looking, large cap universe, cap, small cap side of the market versus the quality of earnings which you may have analyzed?
So we've seen the quality of earnings by and large. There has been not too much of a disappointment in terms of whatever the consensus estimates were, and the kind of numbers that most of the sectors, most of the underlying companies have delivered. That seems to have been met, or probably in some cases actually beaten the estimates. Will that continue going into the coming quarter or Q1? I think that is the bigger call from a broader market or a valuation perspective. Therefore, if you look at the high frequency, the momentum indicators across sectors are clearly pointing out to some kind of a slowdown. And therefore, at the current juncture, from a valuation standpoint, is it too expensive? Probably not. But are we really at those cheap numbers or the cheap valuation numbers? Again, the answer is clearly not. So in some sense, valuations have reached a kind of twilight zone where incremental deployment continues because of the kind of monies that we've seen from foreign, institutional or foreign portfolio investors. Though, of course, June month is not over. June clearly seems to be a relatively tepid month compared to May or March, April for that matter. So I think incrementally what is going to be driving valuations from the current levels are going to be what kind of quality of earnings, or is there going to be a continuity of this earnings, which to our mind probably could take a small breather in this quarter, and that obviously could lead to some consolidation as well in the markets.
If we were to look beyond 3 to 6 months, I'm talking about 2 to 3 year view. What kind of hypothesis would you paint or would you make for our viewers as far as investing landscape in stocks is concerned?
So I think, Ajay, that landscape clearly points to the fact that among the rest of the world, and if I put India into that, even at the current juncture, or if I extrapolate it for the next 2 to 3 years, the growth drivers are pretty much intact, notwithstanding what we are discussing right now. So if there is a place in terms of allocation, in fact, this chat which I was having with the team this morning, where the stock to be bullish on is the stock called India. So I think that's the kind of discussions we are having internally, and purely driven by the macro numbers, which are domestically pretty resilient. There could be some sort of headwinds coming in from the globe, but that is probably more an intermittent kind of a phase. But in terms of are we likely to double in terms of our entire GDP where we are right now? The question is not if we will, the question is what kind of timeline we see in that happening. I think in all of those metrics, clearly, also I must, hasten to add and share with you that we've been meeting a lot of global investors. The same meeting which I had done about 3 quarters back or 2 quarters back, vis-a-vis now, in such a short span of time, clearly there seems to be significant mindset change when it comes to allocations to India. So I think from that perspective, whether I look at it from a domestic narrative or from a slightly more global allocation perspective, there looks to be that there are very few formidable alternatives compared to what India offers in terms of its growth prospects.
Very interesting point you make, Lakshmi. The stock called India, time to be bullish. That's headline material. One last word. This stock has been in the range for a very long time because of the rate hike cycle and slow growth. Recovery was patchy. If indeed first quarter of next calendar we do see a cut, first of all, what are your thoughts? Where does India start the rate cut cycle, and what happens to stock valuations if rate cut cycle actually starts in somewhere 6 to 8 months down the line?
So to answer your second part of the question, rate cuts tend to directly impact, obviously, corporate India balance sheets, given, of course, we've seen significant deleveraging also on India in balance sheets. But clearly, that acts as a positive, fueling factor. Today, the benchmark rates in India are still elevated, given the fact that the globe is still not completely prepared for rate cuts. And when I say globe, I'm referring to specifically the US. So rate cut, if any, in India would be more of an 25 kind of a phenomena, or probably early calendar, CY 2024. That could be the earliest one could think of. Nothing before that. As I mentioned to you, the reason clearly being that one can't be completely oblivious to the fact that US is still not decisive in terms of their rate trajectory. And we need to be mindful of the fact that there is a currency among the Asian counterpart, which is obviously the rupee, which has to be seen in comparison to the dollar. So I think all of these dynamics clearly will be a very, very critical factor. Most of the headwinds in the India macro puzzle have actually morphed itself into tailwinds, whether it's gold prices, whether it's crude oil prices, whether it's our the services buoyancy, which is X of IT, for example. All of that are right now playing in our favor. I think the most abused word, I was supposed to tweet it. Now I'm actually motivated to do it right away. Is that the Goldilocks? I think that's very relevant right now from an India standpoint. So I think yes, much will depend also on the US, not just the Indian macro piece.
Great, Lakshmi. Thank you so much for your time. We always really appreciate your support. We are celebrating our 14th year here on ET Now, and your entire group, the entire team, you inclusive, have been such a great support for us. So thank you very much for your time today as well.
Thanks a lot.